So you thought you did everything right and you got an unexpected tax bill. What can you do? We often get approached by clients who have tried to do the right thing. They've engaged an accountant or a tax advisor, they've got advice on an arrangement, they have then carried out that arrangement and been assessed for tax and ended up with a tax bill that's been much higher than they expect. They then come to us to say, I don't think this is fair. What are my options? It's important to step through exactly what's happened and what the unexpected part of the bill is. Step one, has the actual tax you've been assessed for been assessed correctly? There could be a situation where, based on what actually happened in the situation of that arrangement, that either your accountant in preparing the return or the ATO in reviewing or auditing that return has come to a view that you are liable to more tax than you potentially are actually liable for if you apply those facts or provide more facts to show that that arrangement applied differently. If either of these situations occurred, then it could simply be a matter of working to lodge an amendment to your return, or if you're out of time or the ATO has audited you, potentially putting forward an objection with the ATO to get them to reconsider all the facts of that arrangement in order to get a different tax outcome. However, in these situations, it's important to recognize that tax follows the facts that existed at the time. So if the ATO doesn't know all those facts, then potentially you can use an objection to put those facts forward. But if the facts are what they are and your concern is that you then only had those facts arise based on advice you received, then you might be looking at another form of action. Typically, there are also situations where you cannot change the tax outcome, but you're looking at whether or not you got the right advice to structure your affairs or structure a transaction which has generated an unexpected tax result. An example of that could be where you have purchased a property and there is the transfer of title to give effect to various federal tax benefits to make the most of that investment property, and then you unexpectedly get hit with a stamp duty bill based on the transfer of that property. In these situations, you may have a claim, and often we are asked if people do have a claim against their advisor for professional negligence. People may think that they have a claim against their advisor where they get an outcome that they're not particularly happy with from the Revenue Authority. However, there are three broad categories of things to consider when stepping through whether or not you potentially have a professional negligence claim. The first step is to look at what was the scope of the engagement. It's important to recognize what the terms of your engagement with that particular advisor was. Were they engaged to solely just prepare returns for you? Were they engaged to provide broader structuring of financial advice? Were they engaged to look at both federal and state or territory tax consequences? If the scope of their engagement was narrower than what you expected, while you can perhaps prove that that engagement was broader based on the conduct and understanding of the parties, sometimes there is a mismatch between what you thought they were engaged to do and what they were actually engaged to do. And generally they only owe a duty to you in respect of what they were engaged for. The second part is to properly calculate your loss. Now here, if you get an unexpected tax outcome, you might intuitively think that your loss is whatever the tax payable is, but it's often not as simple as that. Going back to an example I used previously around setting up an arrangement that might have some federal tax benefits but an unexpected state tax consequence, in that situation, if the arrangement was structured in a different way to avoid the state taxes, you might have then had an unexpected federal tax impact for that reason. It's important then when you're working through a potential claim to map out what the counterfactual is on the tax outcome in order to properly assess your loss. Because it's only once you have this figure that you can make the best decision for you as to whether or not it makes sense, both commercially and emotionally, to proceed with any action against an advisor. The last thing to consider is whether or not there are any factors that show that you potentially contributed to the loss you then suffered. Often we will receive aversion events from a client that demonstrate the failings of the other party. However, in these situations, it is quite common to see situations where there are actions taken by the client that potentially exacerbated their loss. Things like not necessarily providing all the facts, to their advisor or delaying in implementing the advice such that circumstances change, or not doing certain events or signing certain things in time that ultimately impact the tax treatment. Now, these issues by themselves may not be insurmountable, but it's very important that as a client you bring these all up at the start so that you can be properly advised of what that position is and not be surprised later on if they come up from the other side. If you feel that you might have a claim against an advisor due to the loss that you believe you'll suffered as a result of their advice, then you can contact Aptum for advice.